Welcome to this TaxSutra Hangout, a special coverage on recently released draft rules on safe harbors. The draft rules on safe harbors were released by the Indian government last week for public comments. These rules have been released almost after a long wait of 4 years and have received a mixed response. We have two guest panel on our panel today to discuss the impact of the safe harbor rules on the Indian transfer pricing scenario and the taxpayers. We have Rahul Mitra. Rahul Mitra is a national leader of transfer pricing at PricewaterhouseCoopers India. We have Manish Batra, who's a vice president at General Electric. Thank you, Rahul. Thank you, Manish, for joining us for this special hangout. Rahul, let me begin with you. Are you disappointed to see safe harbor rules, or do you think they are in line with what was the objective while introducing the law in 2009?
Well, I think it's a mixed question or a mixed answer that probably we need to give. First of all, the government I think needs to be applauded for at least trying to introduce a safe harbor with a view to minimize litigation or to bring in certainty. So the introduction of safe harbor as such, I think, is a welcome move. Now, maybe the form in which the safe harbor is coming or the rates at which the safe harbors have been introduced may not be fully satisfactory. Because if we slowly analyze and just taking a couple of minutes, as if you see the safe harbor provisions in several countries who have the safe harbor regulations, they're intended to cover, let's say, non-core activities, incidental activities, to free up the administrative time of the tax administrators, so that they can concentrate more on on the core services or the core areas for doing the transfer pricing audits. Now, in India, the safe harbor provisions are covering significantly core activities of, let's say, R&D, IT services, which are core to the economy of the country. So from that standpoint, there's a little shift between the way safe harbor provisions are there in the other countries as compared to what we have in India. Now, maybe a better answer to the issue of comparability, and that's what safe harbor intends to cover, trying to get a certainty around comparability, could have been maybe to introduce some of the basic reforms like the interquartile range instead of the arithmetic mean, the multiple data instead of the single year data, where probably one could have had better answers to the issues or to the litigations around comparable analysis. Because I think most of these disputes around comparability is created because of a unique law or unique regulations of the arithmetic mean or the single year data. So maybe addressing that through reforms would have been a better answer than just jump over to safe harbor and trying to cover an all and sundry, whether very high-end services, core services in the safe harbor. So fundamentally, maybe things would have been addressed differently rather than just putting everything in one basket in the safe harbor.
Right, Mr. Batra, you belong to GE, one of the large investor in the country. Looking from perspective of the foreign investors, and really safe harbors are meant to sort of provide relief from the litigation which is being faced by the MNCs. How do you see these rules panning out, and do you think they will help the investors and sort of reduce the litigation in the country?
Yeah, so I think the safe harbor rules, I think the government is taking the first step in the right direction in trying to provide rules which are aimed towards giving certainty to taxpayers. Of course, there is a lot more that can be done, as is the case with any new legislation or draft legislation. Like in most countries where you typically see safe harbor rules for non-core or low value adding type services, I think with the exception of Mexico, where a big attempt was made to handle maquiladoras or contract manufacturers, I think India is one of the few countries which has proposed safe harbor rules for addressing the core of this economy. The entire export sector is sought to be addressed. So I think it's a step in the right direction. There is a lot to be done, and if I can sort of elaborate on some of the things, I think there are threshold limits which have been prescribed by the government selectively for example, for some activities, but not for the others. I think that's an area which the government, can look at and should look at. Equally, for example, on classifications, there are multiple classifications which have been proposed. For example, software, ITES, KPO kind services, or contract R&D in software, and even pharma R&D. So on the services side, they proposed 5 classifications. That is going to cause potentially dispute on which of these categories does the taxpayer fall in. So for example, a software developer, is he really a software developer who's producing application software using existing tools, or is he a contract R&D in software development who is using predominantly, let's say, existing tools, but obviously is going to use 1 or 2 new ideas as well. So is he contract R&D? So I think it's a step in the right direction, but the potential for classification disputes, the potential for large volume service providers not being covered in these rules, are areas which the government can continue to work on.
Right. Mr. Mitra, Mr. Bhadra mentioned a point on the classification of activities, and really there are 2 or 3 aspects. One is the classification of activities, be it KPO or ITES and contract R&D. The second and the crucial aspect which is left open is the service provider needs to be carrying on insignificant risks. Now, these 2 terms are very difficult to sort of demonstrate, but they go to the core of the transfer pricing disputes in the country. So do you think that the safe harbor rules, the way they have come out in the current form, will really help in the litigation, and how taxpayers and how multinational corporations should approach these classifications if they evaluate adopting safe harbor?
So Amir, there are 2 things. One is Manish talked about is on the classification. That means whether a company who is doing ITS is really into ITS, or he is really hovering around the periphery of KPO, or if someone is doing an IT development, software development, and is it really coming under software development, or is it coming under contract R&D for software, where the rates are hugely different? I think that could be an area of dispute, as Manish very correctly pointed out. But on the issue of insignificant risk and the other thing, that is a area I don't see too much of an issue, because you see, the whole idea is for covering these service providers under safe harbors are that they should be contract service providers and not entrepreneurs. And if you see the eligibility criteria is almost similar to what we had in the recent circular on the R&D. That what are the conditions that need to be satisfied for qualifying as a cost plus. So it's a question is whether are you a cost plus type of service provider? If yes, then of course whether you can enter into the safe harbor, the rates of the safe harbor, or if you're not in the safe harbor, of course, then you are out of the ambit. Then you go into your normal transfer pricing audits, but on a cost plus. So classification, I fully agree with Manish here. That could be an area of dispute, and it would be better off for the CBDT maybe to give more clarity. But on the issue of the significant risk or insignificant risk, that I don't think should be too much of an issue. Because anyway, I think the consultant, an accountant is supposed to issue a 3CEB or the basic documentation to satisfy that I'm a low risk contract service provider, and then will be up for the rate to apply.
Right. Looking at the safe harbor rules, the way they have been prescribed, 100 crore is the limit for ITES, but for automotive and contract R&D, there doesn't seem to be upper turnover limit. Any points on that, Mr. Mitra? Any comments on this point? Is it inadvertent or is it conscious that, for example, for automotive sector, any and every entity can sort of avail safe harbor?
Well, so far as the automotive sector is concerned, honestly, I was a little confused, because for all the other sectors, and leaving aside the loans and guarantee, which has nothing to do with the characterization of the company, for
Sure.
all these other services, whether it is IT, ITS, KPO, R&D, etc., they're all catering to the contract service providers. Now, if you look at the definition or the general provisions for relating to the auto components, they are not referring to the company being a contract service provider or a contract manufacturer, to be more specific, either a contract or toll manufacturer. The way the provisions have been drafted, it looks as if it caters to even entrepreneurs and all. So I think that shouldn't be really the the objective of a safe harbor. Even the provision relating to the automotive, that means that the auto component sector, that should also be limited to contract manufacturers or toll manufacturers for being entitled to the benefits of safe harbors, and not entrepreneurs. For instance, the condition which is linked to the automotive companies or the auto component companies are that at least 90% of the turnover has to be for OEM. That means original equipment, makers or the product. So it means that you have to be an entrepreneur to be entitled to safe harbor provisions, which shouldn't really be, or is not really the objective of a safe harbor. So I think that is where the CBDT would need to come out with more clarifications.
Mr. Batra, any comments on this point, the upper turnover cap for some activities and it not being there for others?
Yeah. So I think a couple of things. First, I just want to go back to Rahul's point on the insignificant risk, and where at least I think my sense is that because there is a whole lot of subjectivity involved in determining whether a taxpayer is actually undertaking insignificant risk by way of the 5 criteria that have been prescribed, I think that could also potentially lead to some debate, at least in the software development and on the engineering side. So for example, I think they've specified that only if you are performing economically insignificant functions, employing economically insignificant assets, undertaking economically insignificant risks, working under the control and supervision of your principal, and not owning legally or economically any IP, only then would you qualify as an insignificant risk type of a entity. And I think the determination of that in at least some of the platforms which would be undertaking software, which would be undertaking engineering, would be a hairy exercise. So back to the point of how much this is going to really solve, the proof of the pudding is clearly going to lie in eating it, and how the rule is administered on the ground. Now, going back to the second point on threshold, I agree with Rahul entirely that the fact that we've got turnover thresholds in some but not in the others is probably something which can be rationalized and can be made consistent. So for example, on the software ITES and KPO side, there potentially is a case for not having similar limits so that volume and scale can be encouraged, and and not restrict the application of these rules only to service providers who are less than 100 crores, which would not again achieve the government's purpose of trying to reduce litigation. So I think clearly that can be done. Insofar as the automotive sector is concerned, I agree with Rahul's thought process that the idea is here to refer to or cover contract manufacturers, because think of an 8.5 to 12% type markup or return on costs. A principal or an original equipment manufacturer who is probably the owner of the intellectual property and the technology and the know-how in his products is obviously not going to be set up the right way if it were to earn an 8.5 to 12% type return. So I think the intent is to cover contract manufacturers, which again resonates with the automotive industry, where you will find at a practical level a whole lot of contract manufacturers. So if you do comparable searches, for example, trying to find contract manufacturers, a whole lot of automotive sector companies will drop down. So I think the intent seems to be to cover those, but it will help if there is clarity provided to assessees on that front.
Right. A quick poll, Mr. Mitra and Mr. Batra. ITES cost plus 20%. Do you think that's reasonable, or would you put a different number to it? Your personal views.
Okay, let's put it in this
Mr.
way.
Mitra?
Yeah. So Amir, let's put it in this way. You see, the safe harbor route, and I'm sure Manish will give his concerned views. A safe harbor rate is not an arm's length price. It's a compromise, in the sense that it's a compromise. It's a price which both the revenue and the taxpayer is going to look at it in a manner that, okay, I could have got something better, but that would have involved protracted litigation. So I'm wishing away the protracted litigation in exchange, and I'm getting a result, a certainty, which again is a little higher than the arm's length price, a little worse off than what my optimum result would have been. So from that standpoint, if you're talking about an ITS at 20%, important thing is the threshold of turnover. The turnover threshold of 100 means, let's say if you take into account the markup, maybe your cost will be somewhere around 80 crore. There, if you go to the normal audit or to a normal, let's say to an APA, and let's understand, let's say if you go for a unilateral APA, and I think we can talk about the APAs going forward, but I'm just preponing the answer, or advancing the answer to a certain extent. Maybe you can get a better result somewhere around 14%, 15%. I'm just saying off the cuff. Now, important thing is that for that small level of cost or the turnover, that means a cost base of 80 crore, how much would that incremental 5% be? Not much. So maybe if you say that in a year, even if you had saved that 5% of extra profit in India with an effective tax rate of almost 42%, that means covering the dividend distribution tax as well, your tax payout would be not more than 1.5 crore, 1.4, 1.5 crore, which is not a huge amount of money for a multinational investing in India.
Right.
So maybe for ITS people working with that very small amount of 80 crore, 90 crore amount of cost base, it may not be a bad solution for them. The moment your cost base increases to somewhere around 1,000 crore or 5,000 crore, that's where certainly people wouldn't have gone for the safe harbor. So having the turnover threshold and a 20% for ITS may not be too bad an idea. Of course, this is my personal view, and I'd be happy to hear Manish's.
Yeah, see, I think my sense is that from a foreign investor's point of view, I think while safe harbor, from a sort of platform setting perspective, if I can say, may be set up at a level which is slightly higher or a little higher than the arm's length rate, but I think from a foreign investor's point of view, the critical thing before it opts for a safe harbor is that is there going to be a risk of double tax as a result of opting for the safe harbor, and that's a threshold question which the foreign investor has to cross anyways. So, for example, if a foreign investor is paying a cost plus return to India, will it get a corresponding deduction for that in the home country? Likewise, the taxes which the foreign investor's subsidiary or joint venture may pay in India, would those taxes be creditable back in the home country as a foreign tax credit? So I think the way many foreign investors think about safe harbors is that if the safe harbor rate more or less approximates the arm's length rates, which is arrived at from the actual comparables analysis and the arm's length principle analysis, then it will help the foreign investor in mitigating risk of double taxation and ensuring that those credits are claimed back home. But the moment one deviates from that principle, for the reasons which Rahul validly articulated, the foreign investor runs the risk of suffering double tax, and obviously that has its own economic consequence which impacts decision making. So therefore, I think from the perspective of a number of companies which are going to be keen to participate in this program, if these proposed safe harbor rates were to more or less approximate the arm's length rates, which would be arrived at from a comparability perspective, they would be a lot more palatable and would then go about addressing the government's concern and everyone's concern of reducing litigation, but not otherwise.
Right. Mr. Mitra, now that the safe harbor is more or less a reality, there will be further tweaking perhaps, and CBDT will notify rules which will be applicable even for the current assessment year, that is assessment year 13-14. So basically when MNCs file their transfer pricing certification in November, they will have an option to opt for safe harbors. Most of these companies would have closed their books, maybe the audits would have been over. So if a company decides to go for safe harbor, do you think an out-of-book adjustment to sort of meet the safe harbor criteria would be possible? Your reading of these rules Do you think that that government is allowing that?
I think, Amir, this is a very important point, and I also made it when I wrote in the Tax Sutra column that at least for the first year, when the books have been closed, there has to be a provision for making out of the book adjustment. So let's say, once again, a small software company, who would have, with a small cost base, and would have gone ahead with the cost plus 15 or 14 as the case may be, and now with the safe harbor coming in, he feels, okay, I'm better off in getting an upfront resolution instead of going for the transfer pricing audits and litigations. So what happens? I mean, today if the safe harbor rules are announced, then for that extra 5% which he's offering, whether he'll be entitled to it off the book, adjustment or not, I think there has to be a very clear guideline, a clarity in the safe harbor rules. Otherwise, this is going to be, inviting unnecessary trouble and disputes going forward. So this is something, I mean, I think you've got a very important point. There has to be a specific or express provision to this effect that, for, at least for the first year, companies would need to be allowed to make the adjustment out of the books.
Mr. Batra, do you after going through the rules, do you believe that this out-of-book adjustment is possible? Do you think there will be any other issues connected with this out-of-book adjustment?
Yeah, I think from a reading of the rules, and again, those can be read differently. From a reading of the rules, it does seem to me that an out-of-the-book adjustment should be possible, especially if one sees, for example, one of the rules and the form together with it. But I agree with Rahul that before someone opts for participation in this kind of a program, it would certainly be helpful to get clarity on that. However, that said, I think opting for an out-of-book adjustment in itself is something which taxpayers have to be careful about because of multiple reasons. So, for example, if you make an out-of-the-book adjustment here in India, then obviously the corresponding adjustment back in the home country is going to be suspect. So, for example, just to illustrate, if let's say you are following a 10 to 12% markup in the software sector and there is a potential to accept a 20% markup. Now, if you make an out-of-book adjustment and pay tax on the differential 8% here in India, then and without correspondingly billing that back to the home country, then would the home country really give you a deduction for that extra 8%? Even if they were to respect this safe harbor, would be suspect. So therefore, folks have to be careful on that front. I think equally, an out-of-book adjustment one has to be careful of from an RBI perspective, where if you are saying that you are billing at 10 to 12%, but the correct rate at which you should have billed is 20%, then would the RBI also expect that differential 8% to be brought into country? Now, I understand that there is no corresponding arm's length rule under the RBI regulations, but those are issues which are not as well defined in some of these regulations of exchange control. So one needs to be careful about those. So I think while an out-of-books adjustment would be possible, it will help for the government to clarify. But equally, I think taxpayers have to be careful in thinking through before just sticking to an out-of-book adjustment and not following it up next year, for example, with actual cash billings back to their home jurisdiction.
Right. Mr. Mitra, these safe harbor rules, especially relating to IT, ITS or automotive, mainly deal with the export of services, basically the billing component, and really do not talk about the cost side. In most of these, many of the MNCs on the cost side, you typically have transactions like imports which are necessary for the purpose of exports, or cost recharge from the headquarters, or for that matter even reimbursements, which technically, based on the reading of the safe harbor, seem to be not covered. These otherwise would have been covered in a TNMM approach, the conventional approach. Do you see that is a big drawback around safe harbors, or do you think a taxpayer should be able to justify even these transactions if they go with the safe harbor provisions?
No, I mean, I think the safe harbor was meant to cover, or I would say settle the scores of disputes regarding comparability analysis. That means whenever you're talking about these service providers, whether IT, ITS, KPOs, R&Ds, etc., and the dispute was more as to what the number should be. Should it be 12? Should it be 14, 15, 20, as a case may be? That is what they want to cover. So for for I would say cost recharges, or for some of the imports where comparability is not really an issue, I think that's correctly not being taken as part of the safe harbor. Because safe harbor, let's understand, it's something to settle, or I would say give a solution on the number, on the comparability number, not on the transfer pricing methodology as such. So that way, I think by not covering it, it's not too much of a detriment, which would be, I would say, being caused to the companies.
Right. Mr. Batra, currently we have safe harbors for AY 13, 14 and 14, 15. Typically business cycles probably would be of a longer period. Do you think having safe harbor visibility just for 2 years is a deterrent for the foreign investors to opt in for safe harbor as well?
I think it certainly is. I think most business decisions, or a number of business decisions, are typically backed by robust financial models of what the return on that investment is going to be, which at a planning standpoint is typically for at least a 3 to 5 year type horizon. And so therefore, I think with a 2-year type of a window of certainty, that entire objective is not fully accomplished. Now, again, it's a step in the right direction. Instead of not having any certainty at all, you have certainty for 2 years. So I think it's a step in the right direction. But I think it would help investors a lot more if there was, for example, an alignment between a typical business cycle duration, which, as you mentioned, is 3+ years, and also business decision making kind of a cycle, which is 3 to 5 years. I think if there is alignment with that, then this will make it a lot more attractive for foreign investors.
Right. Mr. Batra, one more connected point is the impact of safe harbor percentages on the ongoing assessments and also the disputes which are before DRP or ITAT. Of course, they are persuasive and not binding, but do you think they will have a major impact on at least the ongoing assessments?
I think so. I think the assessments being done by the tax office, I think this would definitely bolster the thought process of the revenue, that these rates are consistent, are viewed as being consistent by the CBDT, and so therefore it would bolster the transfer pricing officers. I think it will also have a bearing on the DRP because equally, this is a decision which has been validated after much analysis and which has been well documented and made public. Both the rules as well as the Rangachari committee reports that have been made public. So I think this will definitely have a bearing on the DRP's mindset as well. Insofar as the ITATs and, for example, the courts are concerned, I think my own sense is that this will have persuasive value, but beyond a point, these authorities should be and hopefully will continue to be guided by arm's length principles and the exact comparables related disputes which are brought before the authorities. So it will be a point of reference based on which influence will be cast, but hopefully the decision making will continue to be guided by arm's length principles is what the taxpayers would hope.
Mr. Mitra, do you believe that safe harbors will impact ongoing assessments as well?
Yes, I mean, I couldn't agree with more. I mean, I couldn't agree more than what Manish has mentioned. So not only for the ongoing assessment, but also for the assessments to be covered by the safe harbor provisions. When a company doesn't offer a safe harbor, or let's say he's not covered by the safe harbor given his volume, etc., then the starting point would be those numbers of the safe harbor for the revenue. So let's say if you have a contract R&D, a company who is not offering for a safe harbor, when he goes for a transfer pricing assessment, I think the transfer pricing officer is going to start with 30%. Never mind that probably the arm's length price is much lower than that. So certainly it's going to have an impact on the assessing officers, the transfer pricing officers, and the DRPs. And this is where maybe an alternate resolutions to APAs would be a much more welcome solution than to go for the normal transfer assessment, because there will be inevitable litigation and disputes in the era of safe harbor if you do not opt for it and want to go for normal assessment, because that will be the starting point, the benchmark of the starting point for the assessments.
Right, and a follow-up question, Mr. Mitra, on the APA. Do you think that these percentages would also guide in the APA process, especially the unilateral APAs?
Well, I would say that if the APA authorities were to stick to the same rates of 2030 as the case may be, then the APA program is not going to go forward. So it is understood, and I think the APA authorities also understand and appreciate very well, because they're extremely pragmatic set and positive set of people and officers. They realize that this is not really the arms and price, but it's more of a compromise. So certainly the resolutions on the APAs cannot be at the same levels of the safe harbor rates. Of course, the APA authorities will certainly look at the arms and price, looking at proper characterization, proper economic analysis, and come to better results, or I would say, instead of using the word better, more optimum results. Yes, in a unilateral, probably the unilateral APA authorities will be having probably a little more fetters, because they'll be otherwise reporting the same CV, the same revenue board, which is coming up with the safe harbor rates. So their ability to come out with drastically smaller numbers would be slightly limited, but I'm sure they can come up with much better numbers. In a bilateral APA, the fetters on the authorities are much less, because here the negotiation is happening between two sovereign countries, and if dealt with in a proper judicious manner, I'm sure you can have much better results in the bilateral APAs, not mentioning in the unilateral also you can have better results, but I think in the bilateral APAs you should be having the optimum results.
Right. Mr. Batra, do you have any comments on APA, especially unilateral APA?
Yeah, I think the success of the safe harbor program is going to be out for everyone to see. I think we have the draft rules now, and there will be formulation of the final rules based on which folks are going to file their tax returns and the necessary compliances to opt for or not opt for the safe harbor. And I think all of that will be done by November 30th. So I think the proof of the safe harbor program, or the first proof of the safe harbor program, is hopefully going to be out by around that time frame. And based on that, I think the and to the extent the APA authorities are able to review that, I think based on that, the APA authorities are going to be aware of the fact that, well, let me put it this way, that not a whole lot of assessees, for example, have opted for the safe harbor program. Let's say if that's the case, then the APA authorities will potentially not be influenced by the safe harbor rates, and they will continue to apply their own basis for determination of the arm's length proposals. But if, for example, if after reviews and modification, as a result of all of this dialogue up till August 26th, the government formulates and recalibrates the safe harbor rates, which are found palatable by industry, then the APA authority, then it will kind of set an informal standard for the APA authorities to go by as they decide matters.
Right. Mr. Mitra, assuming MNC decides to sort of opt in for safe harbors for this year, what should be the specific safeguard which should be considered while finalizing the documentation? The draft rule suggests that the documentation is mandatory, so per se the administrative relief which was expected to come through from safe harbor is not coming. So what should be the specific safeguards that an MNC should consider while opting in for safe harbor?
I think first of all, when the safe harbor rules are going to be finalized, the CBDT is going to look at this particular compliance aspect of filing a 3CE, the Form 3 accountant's report, and also preparing documentation, whether that will be diluted, and maybe the form which is now to be supposed to be filed, the 3CEG, whether there'll be an addendum to it that let an accountant make a comment that he has reviewed the document and reviewed the function analysis and are satisfied that it is meeting the requirements and eligibility criteria of the safe harbor. That's to be seen. And I think when you talk about the safe harbor, Ameya, it will be more or less similar as to what the MNCs would have need to take into account had they proceeded on a normal transfer pricing audit, means that, to be very specific and clear, that you are a contract service provider entitled to a cost-based form of remuneration. That means a cost-plus form of remuneration, and not veering into the periphery of the profit splits, etc. So whatever you would have done in the normal course to satisfy your documentation towards a contract service provider model, it will be the same things which you need to take into account for creating the documents to prove and substantiate that you are covered by the safe harbor provision. Because if you see, the requirement for the safe harbor provisions is also culled out from the same, the guidelines issued by the CBDT in the circular for R&D. That means you need to be an executor, and a strategic decision need to be taken outside. So that's something which you need to do.
Mr. Batra, your concluding comments.
Yeah, sorry, I missed a little bit of that.
Was more acceptable and. So yeah, Mr. Batra, let me repeat my question. Your concluding comments on what will make safe harbor workable, acceptable to all the stakeholders.
Yeah, I think the threshold limits should be really reviewed, and I would suggest that the same way that out of the 9 sectors for which safe harbors have been proposed, 5 don't carry thresholds. I would propose that even for the other 4, the government should evaluate and see whether the threshold limits can be done away with to ensure greater participation. I would be in favor of, for example, the classifications being reduced from potentially 5 on the services side to not more than 2 or max 3. Do away with the distinction between contract R&D and software. Likewise, don't create an exception for.
Mr. Batra, you were mentioning about your concluding comments. I missed part of it. Could you please quickly give your concluding comments?
Yeah, sure. So I think there are 5 things which I would suggest which will help make this really helpful, this program more helpful. So I think the first is on the threshold limits. Do away with the distinction between ITES and KPO and software versus R&D, and just do away with the limits, the threshold limits for participation in the program. I think that's the first one. The second one is there are multiple classifications. For example, ITES, KPO, software, contract R&D on software. There is case for rationalizing these 5 categories on services to at least, to at best 2 or 3. Is what I would suggest. That's the second one on classification. Equally on classification, I would say that the exception for R&D from ITES activities should be done away with, because at the end of the day we are talking about insignificant risk service providers who by definition are going to be task executors. So that's on the classification side. I think on the rate side, I would propose one single rate for ITES and KPO type activities, and not multiple rates as has currently been proposed. I think the fourth one would be on the duration, where we have currently talked about a 2-year time frame, and as we said, that can be enhanced to at least 3 or going up to as high as 5 years to ensure that business decision cycles are consistent. And I think the last point I wanted to make was on the definitional aspects. So for example, when IT-enabled services has been defined, it uses expressions such as services performed mainly with the help of information technology. Now, what does mainly mean? Does it mean wholly? Does it mean partly? Does it mean wholly and partly? Can again be a hotbed of dialogue and debate between the tax office and taxpayers. And we've seen that in the context of Section 10A on whether you are doing IT-enabled services or IT-assisted services. So I think that's the last point on definitional aspects, and I think that's what I would suggest will help make this program a lot more palatable and successful with foreign investors.
Right, Mr. Mitra, your concluding comments on Safe Harbor draft.
I think Manish has summed up very well. I'll just add a few thoughts from my side. One is, it all depends upon what the government objective is. Right? If we are talking about higher rates, let's take an example. If we are talking about higher rates as compared to what the arms length price is, then there would need to be thresholds. Because a company who is having a high cost base on a turnover is certainly not going to opt for a very high cost, high markup and settle for a safe harbor. That's not going to happen, because first of all, that's not the price which you are going to pay in India, and also secondly, you're going to have significant issues for double taxation in your home country. So that is one, that if you're looking at a very high rates and what rates now, those thresholds are must. And on the other hand, if you really want to cover all the people, I mean everyone, not only those companies with this threshold, with the turnover threshold, but the other companies, then you need to get your rate, safe harbor rate, as close as possible to the arm's strength price. Maybe a 1 or 2% up or whatever, certainly not down, but up. Because in that case, that's the only way that you'll be able to cover everyone within the ambit of safe harbor. That means by bringing the rate down to actually the arm's strength price and not go for a compromise. But again, that will push India's maybe transfer pricing guideline into more of a safe harbor sort of a regime, which you have in Brazil. Like in Brazil, you don't have an arm's strength price; you have a safe harbor for anything and everything. So that's a decision with the government really wants to really want to have. That means, would you want to have transfer pricing regime, normal audits, APAs, etc.? In that case, we should do away with everything, get an arm's strength, get the safe harbor rates down to the arm's strength price, and cover everyone, and everyone lives peacefully. Otherwise, you will need to have this threshold if you want to have safe harbor at those higher presumptive rates.
Right. Thank you, Mr. Mitra. Thank you, Mr. Batra, for your time and sharing your perspective on safe harbor. Surely, the action on transfer pricing is going to continue in India. Perhaps a bilateral safe harbor could be the solution on a policy level, which perhaps government could explore. Thank you so much once again for joining us at this special hangout. The hangout video also will be available on Tax Sutra's YouTube channel. Thank you so much.
Thank you. Pleasure was ours. Thank you very much.